Hello, folks. How's it going? Looks like I am live. Once again, not sure if my video is going to cooperate today. Let's talk about anything you got to talk about today. I only have a few things that I wanted to discuss, and the conversation is first the Nasdaq about 0.72% is up about 0.36, and the broader S&P 500 over 4,000 again, and up about 0.53%. So I was a little bit more active this week on my Discord chat, talking about kind of where I think things are going to go for the rest of the year. And one of the points I made in my Discord group was that I don't see a lot of bright spots outside of some irrational exuberance, particularly around AI stocks right now. I want to caution you guys to look at the earnings of some of those stocks right now, look at what they're actually doing in quarterly sales and things like that before you dive into those. A lot of those companies are carrying a lot of debt. One of the companies that I've talked about a number of times on my live stream here, Moneyline, their growth looks pretty good, but their debt load in comparison to something like their overall capitalization looks really, really bad. I mean, they've got roughly $180 million in debt, and the total capitalization of the company is $199 million, which basically means it's going to be very difficult for them to raise money going forward outside of private placements. They're probably not going to be able to go to the bond market or anything like that and issue bonds. The interest rate on those would be too high for the company to actually make payments on those. You're also looking at, and that's because of credit quality issues in that case, or possible credit quality issues. They haven't missed any payments yet, but you're also looking at federal funds rate. I am going to say right now, the Fed is going to raise rates through May, probably taking a pause in June because of the debt limit fight that will happen. There is going to be a political fight over that that's going to affect markets. And then we may even see a further rise after July, or in July or so. And after that, I expect the latter half of 2023 to look fairly good for stocks. I will say, though, that we are looking at what is likely going to be a rotation back to quality. And rotation back to quality, let's talk about that. There are some growth stocks that are still going to do really, really well, but it's going to be larger growth stocks with low debt loads. And unfortunately, we're not talking about smaller tech stocks that are more exciting to invest in. We are talking about these guys right here, which is going to be really large companies with low debt. So Alphabet and other low debt stocks to consider if interest rates stay high. And there's a couple of different recommendations on here, which is Alphabet, of course, where you have very little debt and huge amounts of cash on hand. Apple is another one of those companies where you have very little debt and huge amounts of cash on hand. Right now, the 10-year treasury yield is just over 3.9%, from below 0.6% about a year ago, which has made these investments in bonds really, really attractive to people who didn't have a huge appetite for risk to begin with. And that's a larger percentage of people in the markets than you probably think. There are lots of people that were forced into the market and forced into buying dividend stocks or something like that just to generate income on their portfolio because they couldn't do it with really safe fixed income. And a lot of people think it's crazy to buy a bond yielding 3.9% when you could own something like Johnson & Johnson, which is a stock and still yields, close to 3% or over 3%. And then you have that potential for capital gain as well. But lots of people are actually more concerned with the potential for loss than they are with how much they're going to gain out of owning something. And I know a lot of people have trouble digesting that sentiment. If you're watching this channel, you probably have an appetite for risk. You don't mind laying some money out there, for the chance of that multi-bagger return, knowing that you could lose it all, right? And that's the attitude of a lot of people that are in the stock market. But a lot of people are not that way at all. Not that way at all. So and one of the recommendations in here is Meta Platforms or Facebook. which has about 5.5% in short-term debt and virtually no long-term debt. And yeah, so, oh, actually, thank you so much, Tell666-999 for the looks like £3 super sticker there, or is that £3? Yeah, super sticker there. Thank you very much. Yeah, I haven't gotten a lot of these lately, and I always appreciate it when you guys do send me the super stickers, and I like to highlight it. So that's not exactly why I do these live streams, because, hey, if I was doing it for the money, I would starve. Yeah, Walgreens is one of the other ones on that list. They have about $13 billion in total debt, which includes lease obligations. But if you look at their assets and their balance sheet, it's going to be a very, very tiny bit of it. So Michael Will says, hi, Jason. What are your thoughts on commodities, excluding oil and natural gas that you covered earlier today, industrial metals, copper, uranium, etc.? You know, uranium is the question that comes up over and over and over in conversations. And we are not seeing the worldwide investment in nuclear energy like I really thought we would see maybe 2 decades ago. And most of that has to do with environmental concerns and permitting. And it's not the uranium mining. Uranium mining is fairly steady. The countries that we would source uranium from here in the Western world are actually fairly friendly to us. So supply is not really an issue. I do think there is some good long-term use to have that in your portfolio. But I don't see a lot of like immediate term bump in that. I could be wrong, of course, but I think it's a good long-term bet. Not seeing a lot of immediate term benefit there. Copper, on the other hand, it's likely to see some depression here in the short term and in the medium term as corporate profits start to decline. Yeah, let's talk about corporate profits starting to decline. And we're not seeing revenues decline. What we're seeing is contraction in earnings right now. And we're going through what's called an earnings recession, where we see earnings start to decline based on wage and price and supply pressures. And that's going to continue. Layoffs that are happening right now, and actually I've talked to a lot of people in the tech industry at this point who have been laid off. And what they're telling me is that things are kind of going in a mindless manner right now when it comes to layoffs, meaning the layoffs are just kind of mass right now. A group of people get together and say, hey, earnings are starting to decline. What do we do? They lay people off kind of blindly. And then a week or two later, they are re-advertising the exact same job with the exact same qualifications, maybe just under a different title. And the people who were laid off are applying for that job and getting rehired. So a lot of these companies that are doing the firing right now are also hiring on the back end. Maybe it's a way to filter out talent, using layoffs to filter out talent without having to go through the process of firing them, because a layoff is very different than firing someone for cause. But that is what's happening right now. I think that the layoffs for the large part in the tech industry are mindless to a degree. And they're just kind of preemptive strikes against contracting margins. And look to see more of that as we go forward, meaning before we even see deterioration in margins for many of these companies, we're probably going to see layoffs. So we are likely to see that carry over to a bit in industrial metals and copper. Other materials, we're not going to see a decline in demand for lithium. We're not going to see a decline in demand for rare earth metals or anything like that. Nickel, and we won't see a decline in that. Where typically in the past during a recession, you would see a decline in nickel. You won't see it this time around, largely because of the demand from the electric vehicle industry. Don't know if you guys are paying attention to the electric vehicle industry lately, but in the last month or so, Georgia is probably the largest beneficiary of the EV of this year of the EV race. And that is because of large projects being announced by Hyundai, project being announced by Rivian, and 2 or 3 other companies are opening up manufacturing facilities in Georgia. So that is that's not really what I expected, to be honest with you. But I'm glad to see that. I'm glad to see that Georgia will be benefiting from that. It is a low income state. So I'm very happy to see that those good paying jobs are going to be moving in that direction. So in terms of what I see might be a good opportunity in commodities, food. food is probably going to be one of the better opportunities in commodities this year. We got a little lucky last year seeing relatively mild weather and bumper crops for everything. This year, we're seeing a small shortage in fertilizer, not in the United States, but we are seeing a small shortage in fertilizer particularly in North Africa, in the Middle East, because they were highly dependent on Russian exports for that. And we are probably looking at a little bit less in the way um, of, of of crops this year. That is not to say also that there might be some sort of disruption in the growing season this year for a number of different reasons. But we're probably going to see wheat prices rise more than they did at the beginning of. They only spiked about 10 to 13% at the beginning of the Ukraine invasion. And like I said, by summertime, a lot of the bumper crop that really happened in Canada and in the United States helped kind of feed the world. That kind of took the edge off of the spike in wheat prices. I don't expect that to happen this year, and I expect to see pretty good gains in commodities related to food. So we're looking at corn, seed oils, and wheat are probably going to be the big ones. So yeah. And hi, Jason. My issue is I sometimes don't set a limit to take profits. So I don't do a lot of selling in my portfolio at all. This year, though, I will probably be repositioning some of my money away from some of the riskier tech stocks that I've been in if we see a degree of recovery by the end of 2023. And I'll be rotating back to quality. I do think that we are going to see a pretty big rotation back to quality here. So this article, by the way, is behind a paywall, and some of the quality growth companies that they're talking about that have very little in the way of debt, have a lot of cash, and still have have a very healthy balance sheet, very healthy revenues and all that. So we're looking at Alphabet, Meta, ServiceNow, Electronic Arts, and Molina Healthcare in this article. So low debt isn't the only factor that makes a stock a buy, but it does remove one threat to valuation. And this list is a good place to start looking for promising stocks. That's, of course, the standard sort of disclosure saying this is not a recommendation to buy or sell any security. Do your own research. Okay, so the other thing to look at here is safety of dividends. We'll look at, with all of the furor going on right now over chips and AI, and you're looking at NVIDIA stock absolutely taking off over the last month, which is nothing new for NVIDIA, by the way. NVIDIA is a highly, highly volatile stock. If you have an option strategy for NVIDIA, it's likely going to fail. I mean, I have sold options so far out of the money that I thought that there was no way in Hades that they were going to be actually exercised, and they ended up being exercised. And I ended up paying taxes on gains that I didn't really want to pay taxes on. I kind of wanted to be in that stock for the long term. So I don't trade options on NVIDIA anymore. I do hold it in my long-term portfolio, but man, that stock is a ride. And it's riding high right now because it's taken an early pole position in AI. The company is being really hurt right now in the chip industry is, of course, Intel. Intel is probably looking at negative cash flow for the next 2 years based on a couple of different analysts' projections. And they just cut their dividend by about 66%, which cutting the dividend by about 66% is bad in the short term for the stock. In the long term for the company, it's probably a better idea. NVIDIA pays a small dividend too, but they haven't raised their dividend for a very, very long time. I think it's like 0.08% or 0.06% or something like that. So, yeah. Wow. Okay. I'll get to your comment here in just a moment. So this article right here is 10 cheap stocks to buy with stable dividends. And their estimation of what stable dividend is what is the coverage rate for the dividends. Like how much of that is actually being covered by current earnings, and all of these are in the positive. A lot of times a company is paying out a dividend that is not covered by their current earnings. And people mistake high dividend rate with actually a good dividend company. And that is not necessarily true. High dividends in most cases are actually a warning sign. They're not a sign to invest. In a lot of cases, if you have super high dividends, the stock price has fallen for reasons that are completely justifiable, and you're likely to see a cut in dividend rate as well. So the 10 stocks to look at here with stable dividends are Verizon, Cisco, Comcast, Medtronic, Gilead, Blackstone, Public Services Enterprise, and International Flavors and Fragrances, Kellogg, and Garmin. This is actually a fairly diversified list of stocks to own too, with like literally like 20% in communications, 10% in medical, 10% in biotech, 10% in technology, 10% or so in financials, and 10% in consumer staples or so, 10% in electronics, and roughly 10% in consumer discretionary. That by itself, with 10 stocks, is a fairly diversified bite of the stock market. So I'm very, that's a pretty good list of stocks that pay dividends, that are undervalued, and have stable dividends. So yeah, let me see here. All right, so let me get to filtering is an interesting term. I've seen it done in FedGov in Canada. Filtering is something that should be done with government jobs here in the United States a lot more. Once you get a government job, it is almost impossible to get fired from it. You have to do something really, really wrong to do that. So I definitely think that companies have gotten that way as well. There's a lot of institutional inertia when it comes to companies, and especially when you're out here on the West Coast. If you get somebody in a tech job, number one, your boss may not understand what you do and what you're responsible for. That is something that always occurs in tech. A lot of times they don't understand the value you bring to the company. And that value could be zero if you're not good at your job, or that value could be great and it's simply not noticed because of how good you are at your job, or because you don't blow your own horn. If you are a young Gen Z person and you are involved in the tech industry, I advise you to blow your own horn and talk about your accomplishments, because I guarantee you, in the corporate world, if you don't do that, someone is taking credit for your accomplishments. And it happens all of the time. A good manager is a person who doesn't want any credit for your accomplishments, and they raise you up. That is not the case, though, with most people that are in management. From my experience, it's that they think that the success of their team should always reflect positively on them, when I think that the success of the team should reflect positively on the members of that team. And that is the true hallmark of someone who's a good leader, is someone who makes everyone in the team look good. And that's surely not happening. But if you want to get ahead in the corporate world, this is not Japanese culture. This is not Korean corporate culture. This is not Finnish corporate culture. Or Swedish corporate culture. You have to brag about yourself. You have to talk about your accomplishments. You have to make sure people know about your accomplishments, and figure out a way of doing it that's not incredibly annoying. That's the hard part. So when I worked with companies from Sweden and from particularly from Norway, and particularly from Japan, that's one of the things that I couldn't get over, is how people were doing great things, and you wouldn't know it unless you asked them directly and put them on the spot about it, because they just couldn't brag about their own accomplishments for cultural reasons. Younger employees tend to do this as well. So this is the time, though, when you want to be noticed for what you're contributing to the company, because you may get unjustifiably laid off in one of these big filtering events. So Hal says, it looks like you changed your avatar to a circuit board. Happy Friday from Australia. I hope you're having a great week, Jason. We are in the middle of Aussie earnings. Supermarket sales and earnings have been very strong. A box of Cocoa Pops cost $10. I guess a box of Cocoa Pops is a cereal. I think we have Cocoa Pops here too. I haven't eaten cereal in years. So basically, when you find out that everyone you're related to has diabetes, you pretty much stop eating sugar and stop eating refined grains just as quickly as you possibly can. So I haven't had a box of cereal in years, although I used to love cereal. So yeah, inflation is still an issue here. It is moderating, though. And I did want to talk today about the Fed meetings minutes that just came out. I don't know if you read about those, but the signaling really couldn't be more clear, guys. Interest rates are still going to go up, and they're going to stay up for a longer period than most people anticipate. I think that the pricing in of basically at the beginning of the year, the market was pricing in interest rates going up by another 0.5 point or so over 2 months. Then there was going to be a pause, and then there are going to be 2 rate decreases by the end of the year. In my Patreon group, through my Patreon, or through the Discord chat, I said in there from the very beginning, the 2 interest rate decreases by the end of the year are not going to happen. It is just not going to happen. The Fed is committed to killing inflation permanently. They see this as the biggest threat to our economy and the biggest threat to monetary and fiscal policy for the government going forward. So this is what they're going to focus on. They don't care that much about markets. And if you read the minutes, the Fed minutes, they are still not happy with the difference in valuation between the S&P 500, in normal times versus now. They still think the S&P 500 in terms of price to earnings ratios is a little bit overvalued. So they are not concerned right now about the stock market at all. Let me see here. How about Apple and Berkshire Hathaway? Although they're almost the same thing, with 42% of the investments in Berkshire Hathaway being Apple. That sounds really wild that 42% of Berkshire Hathaway would be Apple. I would need to go through their notes, in my notes there, to see if that's actually true. That seems almost irresponsible that 42% of investments in Berkshire Hathaway are actually Apple. So I would need to take a look at that again. Did you guys see the article or the interview that Charlie Munger did talking about BYD and how that was the best thing that he ever did at Berkshire Hathaway? I take it that Munger really does not like Elon Musk. He made a couple of what I thought were juvenile kind of swipes at Musk, just making the point that BYD was so far ahead of Tesla. Now, you can look at that and say that's true on the surface. In China right now, BYD is spanking Tesla. They sold something like 71,000 all-electric vehicles last month, in addition to another 75,000 hybrid vehicles. Tesla sold, I think, 66,000 vehicles last month, and that was after cutting prices up to 25%. I think prior to that, they were about 50,000 vehicles in December. So, and that was a rough month because of the Chinese New Year, interrupted sales halfway through January. I'm going to be curious to see if the lead that BYD has in battery electric sales actually widens, out quite a bit more this month. I suspect that it will, because look, the Chinese market is not a monolith. It's highly regionalized and highly fractionalized, with every foreign auto company selling there, because it's the largest auto market in the world. And with more than 130, it's far more than 130 different Chinese auto brands right now. That was the last time I counted. Okay. So it's far more than that. Additionally, though, BYD is coming out with something called the Seagull. There were photos of it leaked, and it doesn't look like this is a prototype model or prototype. This is a production model of something called the Seagull. It is a subcompact starter EV, basically. The beginning price for this is going to be $9,000. It's going to come with a lithium ferrophosphate battery, the Blade battery, that's made by BYD. That they're putting this battery in a lot of their different models right now. And for that market, that battery chemistry works very well for them. And especially for a vehicle that is that size and that price range, I think that could be very, very tempting for a first-time auto buyer who's thinking about buying an EV. And I think that BYD and they're also, no Chinese auto company has really done well selling cars outside of China. Although they've been making better cars in the last 10 years or so, they're still not great. They're good now. They're not great. But if you look at markets like Norway, Iceland, the Netherlands, Denmark, the streets are starting to fill up with Chinese-made EVs. So much so that there were a couple articles written last month that were sounding the alarm that if they didn't do something to compete with the superior margins that Chinese companies have, that your European OEM and automakers were actually going to be in trouble. They were not going to be able to compete. And the answer was going to be trade protectionism, which probably would not work out in favor of Europe in this time period. Trade protectionism would hurt them a lot because of how much German automakers in particular sell in China. One of the weird things that's noted in an article that I've noted before, that Buick sells really well for reasons that are not really well understood in China. I think that's really crazy. Um, so not sure if it's BYD FUD, but now multiple stories read battery fires in some of their cars, and there were car dumping allegations made this week that are claiming to create false sales figures. Some of that is FUD, and largely because not all of their vehicles were made with the lithium ferrophosphate battery chemistry. That's only been in the past year that is really being put into vehicles. But that is probably the safest battery out there that is being produced right now. And it's the only battery out there that you can essentially drive a nail through and it's not going to catch on fire. Everything out there, everything else that is out there, as soon as the innards are exposed to air, it is going to burn as long as there is oxygen available and until it's done burning. And that is that. And it's going to reach really high temperatures. With the lithium iron phosphate battery chemistry, that simply isn't true. It's the design itself, heat management, and the chemistry basically guarantees that it's not going to say that fires won't happen, but it's not going to happen just from a simple puncture. It is far safer than anything being produced right now that is going into Tesla vehicles in the United States, at least. Okay. Tesla does use LFP batteries for export from the Chinese market to Europe, but I don't believe that any of those have made it here to the United States yet. So not sure what that is. And there's always been a lot of false news coming out of China when it comes to business competition there, but it seems to be getting a little bit worse. Now, the car dumping allegations I haven't read into, so I can't really comment. I don't really know if that was Michael Will says, I just Googled it, and the last 13F Apple was 38.9% of Berkshire Hathaway holdings. All right, man, then 42% was close enough, because that literally could just be changes in market cap for between Apple and Berkshire Hathaway. Might have accounted for all of that. There might not have been any buy or sell in that time period. That is very, very concerning. So why would I own Berkshire Hathaway? If I had a choice between owning Berkshire Hathaway or Apple, why would I own Berkshire Hathaway if 38.9% of their holdings are Apple? That would be a pretty big concern for me if I was a shareholder of Berkshire Hathaway at this point. So there may be some other reasons for that. I'd want to take a look at everything else on their 13F and see what are their cash holdings at this point, because they did have an enormous amount of cash on the sidelines through most of 2022, and they started buying at the end of 2022, just in time for a lot of tax loss harvesting sales that were going on. And Warren Buffett and Charlie Munger don't do a lot of short-term purchases, but I want to say that they probably saw the end of 2022 as probably being one of the most active years on record for tax loss harvesting. And they wanted to take advantage of that and buy some long-term investments. So I want to take a look at how much cash they have on hand. So let's take a look right here a little bit when it comes to the Fed meeting minutes. And I urge you guys to pull this up on the federalreserve.gov website every time it comes out. It usually comes out just close to 3 weeks to a month after the meeting happens. And you always have this little press release afterwards. It's never very complete. It doesn't give you the insights that this does. So basically, the Federal Reserve is enormously happy with what they're doing right now. They're really pleased. They think the quarter point increase was not. Everyone unanimously voted on it, but there were a number of members that were actually in favor of continuing the half a point increase. 2 weeks before that meeting, 3 weeks before that meeting, I would not have bet on a 25 basis point rise in interest rates. I would have bet on a 50 basis point rise in interest rates. And it was only till like a week, maybe a week and a half before the meeting that I was like, okay, maybe they only raise it by a quarter point. And I think it was just market signaling rather than doing the actual work of reining back reining back inflation. So that's kind of what they signaled in there. When they review the economic situation, they're still concerned with labor markets remaining tight, and basically the power has shifted towards employees, with unemployment rate at a historical low. Consumer price inflation measured by the 12-month percentage change can steady elevated. Basically, the unemployment rate moved back to 3.5% in December. That is pretty much a record low at this point. Measures of nominal wage growth slowed at the end of last year, but continue to remain elevated. As long as this is elevated over what inflation is, then they are going to keep raising interest rates. The 3-month change in the employment cost index of hourly compensation in the private sector slowed to a 4.0% annual rate in December. Basically, they want that to be about 3%. And for all employees, it eased to about 4.1%. They want that to be 3% over time, and for inflation to be about 1% over time. Over the 12 months ending in December, the ECI increased 5.1%, and the AEH rose to 4.6%. And then they talk about all the other different numbers here that were improving slowly over time, and things were moving in the right direction. And they talked about here a terminal rate, not a terminal rate here, but at least the intention to raise the rate up to about 4.75%. I am predicting right now that the rate by the end of July will be between 4.75 and 5%, which is going to have a negative effect on markets, guys. And I don't think we get to avoid that. Delinquencies on small business loans started to edge up in November, but remained relatively low compared to historical levels. These are things that they're really, really concerned with. But overall credit quality remained strong. There was some deterioration for credit cards and auto borrowers, and some predictors of future credit quality worsened a bit further. That's a bit of a concern, but they know that is going to happen. All right. Whenever you raise interest rates, there are going to be more delinquencies. And this is one of the other things that is concerning when it comes to companies in the fintech space and lenders that are out there. I would be very careful about investments in companies that have concentrated on people in the lower income range and people with poor credit quality. In a lot of cases, your algorithm needs to, or at least your credit management needs to work in a way that the interest rates you are charging on the loans that end up staying current are high enough to offset the amount of defaults. Like, you're looking at Upstart as a company that I'm looking at in particular. When I look at some of the repackaging of loans that they're doing, and I'm not concerned with that when it comes to SoFi. When you look at the credit quality of what they're going to be issuing, I guess tomorrow is when they actually sell. They have a bond issue that's a collateralized debt obligation that's actually going to be signed, or an asset-backed security rather, that's going to be sold. And I posted a sort of a long series of articles or of writings on this in my Discord chat, saying that, all of these, they're selling $440 million of asset-backed securities at a price of like $340 million. And people are like, why are you selling this for $100 million less? Well, you always sell those at a time value of money discounted number to that actual future, the value of that future cash flow, right? So you're not going to sell $440 million of loans for $440 million. It doesn't work that way if those loans don't mature until 2031, or if that whole package doesn't mature until 2031. You always sell it at a discount. So typically what they do, and this is what all these financial companies are doing right now, they're taking up some of the loans that they made in the last 2 or 3 years that were sold at a lower coupon rate than you can sell for today. They've collected interest on these for the last 2 years. They're going to package these loans up and sell them. The credit quality of the asset-backed security that SoFi is issuing is really, really good. And the spread between what they're issuing it for and what it's actually going to be sold for is so tiny that I do not believe that anyone in the secondary market, meaning you and me, we are not going to get a shot at any of that until it comes into the secondary market and it's sold by the people who bought it initially. And you and I, if we wanted to buy it, would end up buying it at a premium to the price that it actually sold for. So that is one of those things that the credit quality of that is so good that and I think that with them having like roughly $5.1 billion on their balance sheet in order to securitize and sell, SoFi is probably going to have another two of these before the end of the year. This market is moribund on scales where, or for securities where credit quality is lower, but it's coming back to life now for assets that have higher credit quality. So yeah, more things going on here that I noticed is they addressed the issue of crypto for the first time in quite a while. And I can't really find that right now when I'm putting myself on the spot. But they addressed the issue of crypto, and what they notice is that the actual traditional banking industry, where they are responsible for managing some of that, has almost zero exposure to crypto, and that FTX's collapse has had no effect whatsoever on the banking system. So the Federal Reserve would not be in charge of implementing any sort of regulation or anything like that. So I think they're only commenting on that to state that there isn't going to be any sort of infection from a crypto collapse should it happen. And let me see if there's anything else that I wanted to cover in here. No, there wasn't. All right. So on to sort of the last article that I wanted to cover, and I still want to be open to any questions here. Best financial stocks of 2023. And this is put out by Forbes Advisor. Okay. And there are some of these that I agree with and some of these that I don't. So I just had this discussion about why buy Berkshire Hathaway instead of Apple. If Berkshire Hathaway's holdings are 38.9% Apple, it doesn't make a ton of sense. But Berkshire Hathaway is not Apple. They are an investment firm. Their 10-year annualized return is 12.3%. 5-year annualized return is 8.3%. I think the best thing about their return, though, is it is not highly coordinated to what the market is doing. It has its own behavior. And that's one of the things that I find very appealing about Berkshire Hathaway. These are the B shares here. Visa is an outstanding financial company, growing in ways that are hard to comprehend for people that aren't in the financial industry. But they've had a 10-year annualized return of 19.6%. That is I don't know if they're going to repeat that in the future, but it's a company that's still growing and it has a market cap of $484 billion. It's got a ton of money in cash. It has very low debt levels, and they mostly make their money on transaction fees and not necessarily by holding or maintaining all of that debt. They don't do a lot of the debt collection themselves. That ends up getting sold to people. And let's remember, the vast majority of people simply pay off their debt every month. JP Morgan is another one of these groups on this list. Annualized return over the last 5 years is 6.5%, 10-year annualized return of 13.2%. As a disinflationary play, we're looking at probably JP Morgan, Bank of America, Wells Fargo, and Morgan Stanley and Citigroup doing very, very well coming out of this inflationary environment and going into a deflationary environment. So the company that I would probably avoid in this group is probably Citigroup, and it's not because of their low 10-year average annualized return. It has more to do with their strategy going forward. Morgan Stanley is going to benefit going forward from new bond issues at higher interest rates. It's going to benefit from companies going IPO. It's going to benefit from higher trading volumes as we turn around, more so than any of these other companies on this list, even more than Bank of America and JP Morgan Chase. Bank of America, JP Morgan Chase, and Wells Fargo are going to have an issue pretty soon where they're going to start losing deposits to fintech banks again. They've been doing that through all of 2022, but they were not very concerned about that. When you look at a company like SoFi going from $1 billion or so, $900 million in deposits in January of 2022 to like $8 billion, $9 billion by the end of the year. I don't know what the number was. I think they brought in 8.5, a little bit more than $8 billion in deposits. You don't see deposit growth like that percentage wise for even a small brick and mortar bank. It just doesn't happen that quickly, especially when it already has $1 billion of deposit. Your average deposit base for a bank I think in the United States would probably be somewhere around like the $70 million range for each bank branch. And if they get 20% increase in deposits for a year, that would be an enormous increase. And those bank managers would be getting these giant these giant bonuses based on that. So JP Morgan, Bank of America, and Wells Fargo are very quickly going to run into a phenomenon that happened many times in my career when I worked for bank brokerages, is that the incentives aren't aligned for the people who actually manage the deposit base and the people who make the transaction revenue for financial products. The incentives are not going to be aligned because interest rates are going to be too high. So right now, Wells Fargo is paying like 0.1% on a $500,000 deposit. So there's still incentive for that bank manager to say, okay, man, I'm going to refer you to Wells Fargo Finance. So Wells Fargo Finance is actually a separate company from Wells Fargo and Co. They're not banking and investment banking have to be separated. Banking and investments have to be separated, right? But money, based on how accounting rules work, money that leaves the bank side of Wells Fargo and goes to the financial services side of Wells Fargo actually counts against the deposit base of the branch manager. So the incentive for them to refer business over to Wells Fargo Financial is about to evaporate. And when that happens, you're going to see commissions and fees decline fairly rapidly on that side of the business, and it's going to drag down the balance sheet. Morgan Stanley, on the other hand, is a bank that's never had that issue. They have a very different structure of their business. So we're probably looking at Bank of America, Morgan Stanley, and Citigroup not Morgan Stanley, Wells Fargo, Bank of America, and Citigroup underperforming the Morgan Stanleys and the Goldman Sachs and those sort of businesses going forward. But I think that most of these financial companies too pay a dividend as well. They have really healthy balance sheets. They're based on their regulations. They have to have really healthy balance sheets. They're involved in a business that tends to do well, whether the economy is good or not. That was always an adage that I heard over and over and over when I first got into the investing world, is that financial companies, banks make money no matter what the economy is doing. It's sort of like trash companies, right? A trash company like Waste Management makes money no matter what the economy is doing, right? Because it is a necessary part of our economy and you can't avoid using it. But some operations are going to fare better coming out of this than others. And I think out of this list right here, China Construction Bank is the one that I wouldn't touch with a 10-foot pole, largely because of how in bed with the government China Construction Bank is, and the fact of just a number of different facts. There are lots of Chinese companies I wouldn't mind owning, but China Construction Bank is not one of those. I think that they've got massive problems coming here in the future. But Morgan Stanley is probably one of your better bets here. Visa is probably one of your better bets in this list. MasterCard as well. MasterCard is probably actually cheaper on a valuation basis. I mean, if we look at the earnings per share versus their price, it's probably actually a little bit cheaper on a valuation basis. All right, guys, it is 1:45 here. I'm going to hang on for a few more minutes and see if you guys have some questions about stocks. I hope you watched that video that I made earlier today on the oil industry and fracking. And that video came up because somebody sent me a TikTok video of from Mr. Global on TikTok, and was like, hey man, this guy has no idea what he's talking about when it came to like fracking in the oil industry and how much has affected our economy. And I was like, no, you're wrong. He knows exactly what he's talking about. And I happen to know all of the numbers behind that because I'd done the research before and I wanted to turn that into a video. Man, I was really trying to make it like a 10 or 12 minute video. And I'm sorry that I don't know when to shut my mouth. But yeah, but the issue with the oil industry and fracking is that fracking basically stopped a giant transfer of wealth, or at least slowed it down really significantly. This giant transfer of wealth that was going from the United States to oil producing nations. And it's not an accident that we put sanctions on Venezuela and sanctions on Iran and sanctions on Russia over those years to stem that flow to a degree. That's not an accident. But that's not the real issue. The real issue was it was just good old-fashioned capitalism and American ingenuity that created the fracking revolution, which was a technological revolution, which increased our oil production from about 5 million barrels per day to roughly 12.3 million barrels per day. All of that came from fracking. All of it. I mean, I'm not kidding. All of it did. But that's not the real story there. And I didn't put this in the video. So in 2005, when we were producing 5 million barrels a day, uh, production didn't immediately go up. It didn't go up, I think, until 2009. But by the time production went up above 2005 levels, that was actually the first increase in oil production the lower 48 in the United States had seen for 18 years. Production had been declining for 18 years. And the reason I kept using the 2005 time number in there is because that's the beginning of when fracking really started being used commercially. But it's also when I was having really serious discussions with people in the oil industry about what our economic future was. And basically, they're like, we're screwed, man. Money's going to be flowing out of this country for the next 100 years until we can't pay for oil. And then we're going to go back to horse-drawn carts. Like that was literally the sort of solution. People couldn't see anything else in the future. And people ask like why I'm so anti-oil. I'm not so anti-oil. I'm just not putting any more money into oil at this point. Largely because even the fracking boom in terms of oil hasn't reached its peak yet, but its fever pitch of pickup in terms of production is probably over, and it's going to peak sometime in the 2030s, early 2030s, and we'll see a steady decline after that, right? But until we really are back to that 5 million barrels a day level sometime in the 2050s. By the time the 2050s roll around, we better have another solution in terms of powering transportation and industry, because we will not be able to afford the oil no matter where it's where it comes from. We're looking at right now the reserve capacity of Saudi Arabia. They are, I think, the second larger producer of oil right now. They say they have maybe 2 million barrels of reserve capacity. I actually don't believe them. I do not believe that they have 2 million barrel reserve capacity. I think they might have half of that, right? The 500,000 barrel per day production decrease from Russia that we've seen in the last couple of months had zero impact on the market. I don't believe that that's actually a response to purely a response to sanctions. I think part of that also is their oil fields have seen a natural decline. If you look at the production cycle of an oil field, it produces anywhere from 40 to 60% of the oil that it's ever going to produce in the first 2 years of operation. And then after that, you see a slew, anywhere from 40 to 76%. And then you see a slow decline for maybe 30 years until it's producing nothing, right? And then sometimes we've gone back and been able to refract those wells years later and get more out of them. But this is not going to happen with wells that have been fracked over and over and over. And that's what's happening right now. Gas, on the other hand, we still are going to see with natural gas like a huge increase in the market going forward. So but it's been responsible for a huge portion of GDP growth in the United States and Canada for the last like 14 or 15 years. Massive. And watch that video. So anyway, so these are the things that I think about when I'm alone. So that's my life. Let me see. So, hey, Jason. So today I'm feeling like I picked up nowhere enough NVIDIA at 125. Man, I only bought a few shares of NVIDIA when it hit like 128. I was right behind you on that. And I'm the same way. I wish I had picked up more. It's part of my overall long-term portfolio, and I don't do any short-term trading around it. I do a lot of short-term buying around it, but I'll be taking some profits this time around when it gets up around $280 to $300 a share. And just because I've missed so many opportunities to take profits on that. So what I'll probably do is end up selling it, turn around and sell an out of the money put on that for, like 6-7 months out in the future and earn another 10%, whether or not that put ever actually fires off. I won't sell all of my holdings, but I will sell some of it at around 300 and lock in some of that profit and try to profit if the price goes back down again. But then again, like I said, I'm not doing a ton of like short-term trading. If I sell more than once every 2 years or 3 years in Nvidia, any at all, I'm kind of failing at my at being disciplined. So yeah, I saw the benefits of fracking to sand trucking in Pennsylvania in 2014, cycling on a very busy road. Yeah, a lot of people not in the oil industry wouldn't realize like how big fracking is in Western Pennsylvania, how much business and economic activity it's generated. And it's not just businesses that are directly related to the oil industry either. From 2013, when tight oil resources from carbonate, from shale, and from sandstone really took off, that's when we saw prices dip and stay that way for a very long time. And the spike that we had in 2008 was part panic from folks realizing that the United States had been continuously in decline in terms of oil production for 18 years, and that we didn't control oil production anywhere, and that prices were only going to get higher if something didn't happen with production. Part of that was what drove that huge spike up to $156 a barrel or something like that. I think it was 147 was the top in 2008, very briefly. And then it was the crash of 2008 that sort of brought that down. But as in the middle of the crash, you actually saw companies in the United States start to produce more and more oil. One of the things that we basically stopped doing, which is offshore oil exploration. You guys probably don't remember this, but between 2000 and 2008, there were all kinds of offshore oil drillers like Hercules Oil, Diamond Offshore Drilling, and Rig, and a couple of other companies out there. Their stock was going through the roof. They were paying massive dividends because they were drilling offshore in the Gulf of Mexico and off the Atlantic. That business is not completely dried up, but it is a shadow of what it used to be because of fracking. And exploration has really fallen off the deep end when it comes to what's going on in the Gulf of Mexico. And look, oil spills on land don't make nearly the bad PR that oil spills in water do, because of, drowning birds and fish kills and that sort of things, birds covered in oil. But at some point, I do expect that drilling in the Gulf of Mexico will resume. Mexico has never stopped exploring and drilling for oil in the Gulf of Mexico. It's really been Texas where that business has kind of dried up. And so oil industry is very interesting. I am not so much against the oil industry because of environmental reasons. I mean, it's nice that if we switch to EVs, we're able to concentrate and contain the emissions that we are making, meaning it's a lot easier to capture all of the emissions that are coming from a central power plant rather than it is from billions of oil-using vehicles on the road every day, right? So even for making the same amount of carbon, it's the concentrate and capture that we're going to be able to do a lot easier. It's better for the environment. But what I really don't like about the energy industry is the power dynamics, geopolitics, and the fact that that the quest for cheap energy has sparked so much warfare and human misery over the last 150 years. And really, the war in Ukraine is no different. This war in Ukraine was all about Putin being able to maintain economic lordship over the rest of Europe. He got them dependent and hooked on natural gas and on cheap oil, and he thought he was going to be able to use that as a bludgeon in the future. And I'm sure he saw this happening probably a long time ago in 2005. He thought at some point that he was going to be, because he was the number one producer of oil. Russia was the number one producer of oil for a few years. They believed that they were going to be the masters of the universe and extracting oil dollars, petrodollars from everywhere on the planet. That didn't happen. It didn't happen as fast as he wanted it to. And he saw himself losing leverage, particularly after 2016, when Cheniere Energy first started to export liquid natural gas, using tankers. And that fleet went from a few dozen tankers in 2016 to more than 700 by the beginning of 2022. And that fleet is looking to almost double in the next 2.5 years, just based on deliveries that are already on the books, meaning ships that are being built right now at shipyards in Korea and France and Norway. Shipyards that are being built in Korea, France, and Norway right now. The fleet of liquid natural gas tankers is going to double. There are 33 different liquid natural gas terminals that are either under construction or in planning stage or expansion stage in Europe right now, in addition to the 29 that are already operating, which I didn't believe that we were actually going to be able to keep Europe supplied with natural gas. I was wrong. I underestimated the ability for them to store natural gas, and I underestimated the ability of their ports to handle it, and they did too. So, yeah, you see here. Will you be turning into the Tesla Investor Day? Tuning into the Tesla Investor Day. Do you think there'll be anything new coming out of it? Well, I do think there's going to be an announcement of a direct investment in a lithium mine. What I hope is going to happen, but what is not going to happen, is the official announcement of a $25,000 or $30,000 even electric vehicle made for the mass market. They need to do something about their vehicle line. It simply isn't fresh anymore. It's not enough for them to be a technology leader. They have a lot of competition now, which is something they never had before. What was it? There were 150,000 Hyundai electric vehicles sold here in the United States this year, which is a 56% increase. You have a lot of vehicles that are competing with them. And I can tell you right now, it does not matter that Ford's, what was it? The E, whatever their Mustang electric vehicle is called. I can't think of the name right now. It doesn't matter that it's not technologically the vehicle that Tesla is. It's good enough for a lot of people. It doesn't matter that the Hyundai's vehicle is behind Tesla's in terms of technology. It's a good-looking vehicle, and it's a good enough vehicle. And they are not sitting on their hands when it comes to developing new lines. The Ioniq 6 is coming out the next year, which is supposed to be absolutely fantastic. You're supposed to be able to charge up to 80% in 15 minutes with their new battery technology. So they're not sitting on their hands. Tesla needs to move in terms of design. They need to move in terms of the Cybertruck. They really do. The only thing limiting Ford right now from selling more Ford Lightnings is the fact that they're already at max capacity. The location they have to build the Ford Lightning, which is at 150,000 units, is at max capacity. Last year, they weren't fully ramped up. This year, they are going to be fully ramped up. Basically, the entire model year is sold. And the only thing preventing them from selling more is the fact that they can't make any more. Tesla needs to step in as quickly as possible with the Cybertruck, figure out if there's an appetite for such a weird-looking vehicle. If there is not an appetite for such a weird-looking vehicle, quickly redesign that shell and remarket it as something that looks like a truck. And honestly, man, I think that might be a big drawback for a lot, even though it can do everything that a truck can do. The Cybertruck will be able to, unlike the Ford F-150 Lightning, it really can't do everything that a truck can do. But if I can get 300 towing miles at full load of 12,000 pounds from a Tesla Cybertruck, it's got officially has a range of like say 600 miles. If I can get 300 towing miles on with a full load, I would consider that being able to do everything that a real truck can do, right? The Ford F-150 Lightning can't do that right now. Your range is really short, and it's going to make trips really long. And I think that that's kind of the weakness of that. But even with that weakness, it's sold out. It's sold out of all of its production, and I think that's fairly amazing. The Tesla Cybertruck, even though it can do technically everything, it may not sell well. Look at what happened to, and none of you watching this are old enough to remember this. Ford did a redesign of the F-150 in the mid 1990s, maybe early 1990s, where they just went from everything being square to all edges being rounded, right? And you would not believe the hate that came out for Ford trucks in that time period. It crushed their sales that year. They didn't lose their top spot in terms of the best-selling F-150, but it crushed their sales that year, and they had to offer some massive vehicle incentives to get people in that thing. So I disagree about competition coming. They don't have the charging infrastructure. Many horror stories. Bram, this is one I usually agree with most of what you say, and this is the one time I'm gonna disagree with you. roughly 62 to 64% of people who buy an electric vehicle are never going to use a charger. They're going to use their home. They're never going to go on a long trip because they just won't. If they go on, you couldn't pay me money to drive to Las Vegas from my house, and that would be the only time I would need a charger is if I was going to drive to Las Vegas. I'm going to fly. I'm not going to. At best, I'll make it there in 5 hours if there's no traffic. But I have to drive through LA, so there's always going to be traffic. So it's a 6 or 7 hour deal, right? I will fly to avoid that any day. If I have an electric vehicle, I'm never going to drive it more than 50 miles from my house, just because I don't drive more than 50 miles from my house if I don't have to. And that's the vast majority of people that are worried about driving really far from their house. They're not a large part of the market. And even if you look at the people confined to rural areas who have to do that all the time, they're still not a large part of the market. Most people that buy trucks actually don't use them for truck stuff. And that's one of the reasons why I think that the Ford F-150 Lightning is selling really, really well, is that most of the people that are buying it because it looks like a truck. And most people who own a truck because it looks like a truck, not because they do truck stuff with it. They're not hauling around sheets of plywood or pallets of cinder blocks or loads of dirt. They're just not doing it. They drive a truck because they may occasionally throw a surfboard in it or something, or go camping, but they're not really doing truck stuff. Let me see here. Most pickup drivers just want a cool truck. Utility secondary. Cybertruck will be epic. Man, I hope it is. I hope it is, because I do own a lot of Tesla stock. So I hope the Cybertruck is epic. So what do you think about the future of public charging looks like? You said there's not much money in charging companies. So did you guys hear what happened with the military bases here in San Diego? So right now, military bases here in San Diego have about 100 chargers, but all but 4 of them are reserved for government vehicles. Now they're all getting public charging, right? So there's only 4 public chargers at San Diego Naval Base right now. They got a couple of $1 million in grants to put in public charging. You're probably going to be looking at governments getting more and more involved in public charging. And this is going to happen first in California, because by 2035, the state government is no longer going to be buying anything but electric vehicles. They want to do as much as they can to promote EV infrastructure, and they may actually be able to make money off of EV infrastructure. If you think about it, EV infrastructure is relatively easy to maintain. It's not going to be broken that often. There's nothing about a charger that is special at all. It's basically just a glorified plug. And if you look at electricity rates here in California, there's no reason why you couldn't charge a premium. If you charged a premium rate, I would have to look up what electricity rates here are in San Diego. You see, let's look up LA because it's a better loss. Electricity rates. You look at electricity rates in Los Angeles, 26 cents per kilowatt hour, which is a lot higher than a lot of parts of the country. You could double that, and it would still be more efficient than putting gasoline in your car in California. So Los Angeles is actually 10% lower than the average electricity rate in California. Let's see what it is in San Diego. I don't even know, because I have solar and run 100%. Yeah, so San Diego County is 36 cents per kilowatt hour. So it's a lot more expensive than Los Angeles, and it's 60% higher than the national average of 23 cents per kilowatt hour. So that's just San Diego. I've been on solar for 8 years now and have not paid an electric bill for that long, so I wasn't aware it was that high. California is not the world, but everything we do gets exported. It's a lot like the United States has never caught a recession from any other country in the world, but we certainly have exported a lot of recessions. And you would really need to take a look out here at California and look at how much of this country or this state is rural, where we have low population density, where we are able to pretty much test every kind of need that is around. And this is one of the reasons why Southern California is used to test vehicles from all over the world. Like, I have seen vehicles that were made for the Indonesian market being tested here, vehicles that are made for the Philippines being tested here, vehicles made for the Latin American market being tested here. It's basically because you can get any conditions you want here based on testing the vehicle. And I posted in my Patreon group too a picture of a JAC Frison truck that I sighted on the road here while taking my kids to school. JAC is the Chinese manufacturing partner of NIO. They're a state-owned Chinese manufacturing company, and they sell well enough in Latin America that I'm seeing their trucks on a regular basis now. Not every day, but like at least 2 or 3 times a month, I'm seeing these JAC trucks. And I don't think I've seen one yet that is fully electric, but I have seen one of their hybrid versions. It comes in gasoline, diesel, hybrid, and fully electric. So when I say things that happen here, when it comes to the vehicle market, most things are tested here before they're exported other places. Yeah, there's no reason not to prefer Square over MoneyLion. I bought a lot of MoneyLion as a giant speculative bet. It could all go sour. Largely because, and I kind of covered this really briefly at the beginning of the live stream, they're going to have a really hard time raising money. They cannot go to the bond market right now. It's going to be very hard for them to borrow money under traditional borrowing metrics, and they're really stuck with private equity and trading it for equity. Largely because the outstanding debt they have now at 186 million or so is pretty close to what the total valuation of all outstanding stock is, which is about 199 million. So this is a company that if they don't race to earnings, they won't make it. If they still stay focused on growth at all cost instead of getting to positive earnings at all cost, they will not make it. So if you're buying MoneyLion stock right now, great. It's a speculative bet. It's never been an investment. Okay. It's not an investment really until I see that it has the ability to function normally in capital markets, which it is not at this point because of how low the share price is, how high their debt load is, and their growth looks great. And to be honest with you, the earnings that are coming out on the 14th, those are coming out before market open. That's a really good sign for MoneyLion. You usually don't want to report earnings before market open. You do it after market open and give people a little bit of time to digest those earnings before they go back into the market, decide to dump it or sell it, right? This is a good sign for them. But I downloaded their app. I played with it. There's nothing that differentiates themselves from a lot of other fintech apps that are out there. Some people will like it. Some people will not. How they market is going to be how they're going to be successful. They do have a really strong education component to what it is that they do. They do offer a really varied option for a number of different, especially lending options. They offer tons of different lending options. So, and it's obvious because I went partway through the application process just to see what it was like, and now they won't stop calling me. But they make it obvious that their lending options are coming from other places, unlike with SoFi, where they do sell third-party loans as well, or at least they did. And it's not obvious when you're going through it that it's actually not coming from SoFi itself. So, Coops Roland says, hi, Jason. So Coop is one of the students at my academy. He has his own jiu-jitsu related channel. I have done nothing with my jiu-jitsu related channel. I've just been because I'm focused on doing this one. Go check it out when you get a chance. All of that is shot, or almost everything that he does is shot in my academy of people rolling in there. So yeah. Do you think New and SoFi could end up going head to head and say absolutely? They will. That's not even a question. I expect SoFi to expand to Argentina, Brazil, and Colombia in short order. I think that's going to happen in the next year, 2 years at the most. So Argentina, Brazil, and Colombia. And largely that's going to be on the back of Technesis. Technesis is a company that I believe was started in like 1993 in Buenos Aires. And they're very, very strong in Brazil at this point, and they're making huge inroads into Colombia as well. Banking in all over Latin America is even more antiquated than it is here for older people that are, say, my age. Like I never go to the bank; everything's done electronically. but a lot of people my age still like to go to the bank and stand in line. Every time I go to the bank and have to stand in line, it's not a happy day for me. But yeah, so the issue with them is there's a lot of room for modernization. Their demographics look better than ours do. When you look at the size of the younger generation, the size of their version of Gen Z is a lot larger than our Gen Z is, right? So there's a larger addressable market to a degree. They have less money, but there's a larger addressable market there. And taking a little bit from a lot of people is better in a way than taking a lot from a few people, right? Depending on how wide your market is. SoFi, on the other hand, I don't know how they're going to enter into the Latin American markets, but Nubank right now, which is that's how they're known in Latin America, is killing it in terms of expansion. They are very much focused on, though, growth at all costs. They will not stay profitable as they're expanding. I think they're profitable right now, but they're not going to stay profitable as they're expanding. That's going to change. They're so well capitalized, though, and so well backed that I don't think they're worried about it at this point. But SoFi will absolutely start competing with Nubank. And Nubank uses some Galileo technology, but they're not on the Technisys backbone. Nubank built their own banking backbone for that. So Dewey says, just opened my electricity bill, Canadian 23.46 per hour, all included, taxes includes 60% nuclear. What a lot of people don't realize is that California electricity prices, like Los Angeles is being 26 cents per kilowatt hour. That's actually surprising, but it shouldn't be when you look at how much of our power actually comes from hydroelectric. It's a lot. It's a fairly large percentage. And last year, it was a higher percentage than it had been in like 5 or 6 years. This year is going to be pretty good for hydroelectric power as well. But we are in a multi-year drought here. We've seen that break a little bit here in the last couple of months, but that goes a long way towards lowering our electric costs. But California has shut down its, I think it shut down the Oceanside power plant, which is basically, it's iconic because of the way they looked. And I'll post a picture of how that looked. In fact, you could see it in, oh man, I can't remember the name of the movie, but it had Leslie Nielsen in it. And they drive by, there's a hilarious line. It's called The Naked Gun is what it was. And they drive by the power plant, and he's talking about his ex-wife and how everything he sees reminds him of his ex-wife. And if you see a picture of the Oceanside power plant, you'll know what I'm talking about. But anyway, that was shut down a few years ago. And I remember because I was a financial planner back then for a large company, and I got a ton of business from people that were basically kind of forced into retirement, and they were moving over their retirement plans. But yeah, so I don't know. Well, I mean, other than the fact that there's always an earthquake danger in Southern California, I don't know why we don't build more nuclear power here in the United States to diversify our sources of energy. Nuclear energy, in a way, is going to be more reliably sourced than trying to draw oil out of the ground in the future. Meaning there are a number of ways to do nuclear power that we haven't exploited yet. And a lot of that has been resistance from environmentalists and resistance from people who aren't really looking at the science, and they're just looking at politics. And I'm mostly talking about environmentalists on the left. And granted, it's divided. There's a large portion of them that say, hey, this is more environmentally sound than you think. And then a large portion that are still saying 3 Mile Island, 3 Mile Island, 3 Mile Island. The total radiation exposure you would have gotten from 3 Mile Island is about the equivalent of owning a microwave for a year. So that is how little radiation was actually produced by that event that people were actually exposed to. But it didn't matter. It seared itself into our collective consciousness, and people don't look at the actual cost-benefit analysis of nuclear. Yes, it's more expensive than we're doing right now, but the benefit is that we can source most of our fuel here, and it can't be controlled by anyone else. And we're not subject to the sort of energy blackmail that we are right now. And we are still able to be subjected to energy blackmail if our adversaries were to cooperate. They would be able to do that. They were able to do that in 1973 with the oil embargo. Very few people that are watching this, maybe no one watching this, remembers what that was like. But basically, that's when the entire OPEC, Arab members of OPEC decided they were no longer selling oil to the United States because the United States' support of Israel during the Yom Kippur War. So Henry Fonda should have used a condom. Man, you always have the best one-liners, and honestly, man, that is a good place to close this live stream, as I've been on a little bit longer than I intended. I'm actually not feeling all that well today. I've got some stomach issues. Gonna hop off here, but I'm going to leave that there right now. Henry Fonda should have used a condom. That's how I'm going to end the live stream. Thank you very much for showing up today, guys. I really appreciate it. I will see you on Monday, I believe. I don't believe I have any scheduling conflicts for Monday. I'm going to have out another, I'm trying to do like one sort of deeply researched video per week. That seems to do better than live streams do. Also, do not understand the algorithm. That video is getting a lot of views for reasons that I can't fathom. The algorithm just started recommending it to people. But if you haven't seen the video I put out this morning on the oil industry and how Putin's dreams got crushed, go watch that. I put a lot of effort into it, and I did all that research a while ago and finally put it into video form today. I did it for other reasons, but I hope you guys enjoy it. Thank you very much, and have a nice day.